Hi, everyone. I'm Trish Cousins. I'm a finance and loan analyst on the Lender and Partner Activities branch, and I just want to start by saying thank you for attending today's training. I know that it takes time away from your day, so thank you. Um, Today, we are going to touch on the following topics, and hopefully by the end of the training, you'll have a better understanding of our programs and how to administer them. So let's get started. USDA is actually one of the largest federal agencies, and we have more than 70 programs to support rural America. I just want to do a quick review of some of the programs that rural development has to offer. We'll start with the single-family housing programs. They provide the opportunity to purchase, build, or repair affordable homes in rural communities with both our direct and our guaranteed loan programs. Then we have the multifamily housing program, which provides subsidized multi-unit properties in rural communities for low-income families, elderly disabled individuals, as well as farm labor housing. We offer loans with subsidized interest rates, and we require that the properties offer subsidized rent along with rental assistance from rural development. We have our telecom and electric program, which offers the Reconnect program, bringing broadband to rural communities. The Community Facilities Program funds essential community projects like police or fire stations, public use vehicles, community centers, schools, hospitals, and things of that nature. The Water and Environmental Programs, they fund essential water and wastewater projects, which includes new facilities or upgrades to current facilities. And then lastly, we've got our business and co-op programs, which assist businesses large and small in rural communities. So as you can see, we can essentially fund a rural community from the ground up. It's a pretty cool agency. We are here to talk about the Guaranteed Loan Program, but I do like to touch on the Direct Program just to raise awareness. So if a borrower does not qualify to go conventional FHA, VA, or through our Guaranteed Program due to income, it is possible to refer them to a rural development office in their area just to see if they qualify. So basically, instead of saying, no, I can't help you, it's easier just to say, I can't help you, but maybe they can. The direct program offers 100% financing, just like the guaranteed program, but it's for homeowners with low to very low income, and it helps them to purchase a home in a rural community. Depending on the borrower's income, though, interest subsidy may be available, which gives the borrower more buying power. The program is actually administered directly through rural development, so to find an office in your area, you would go to the link in the lower right-hand corner of this slide. The direct program also offers a 504 loaner grant to make home repairs for safety and sanitary purposes. And the program is available to people with low to very low income as well, and it is administered directly through the rural development offices too. Okay, so let's talk about the Single Family Housing Guaranteed Program. We, Rural Development, help our lending partners assist borrowers with low and moderate income purchase or refinance homes in rural communities. Our lender partnerships are the key to the success of this program. So for that, I want to say thank you for getting the program out there. We really appreciate you. The approved lenders are responsible for originating, underwriting, servicing, and liquidating the loans. The lenders are also responsible for ensuring all program requirements are met and that the underwriting procedures are followed. Rural development, we review each loan to ensure the applicant and property appear to meet program eligibility, but we do not underwrite the loans. The lenders do. The mission of the Single Family Housing Guaranteed Loan Program is to serve low to moderate income rural homebuyers, assist homebuyers in obtaining adequate, modest, decent, safe, and sanitary housing, and guarantee sound loans which otherwise may not be made. So let's start with the benefits to the borrower. I think the best is the opportunity to finance 100% of the purchase price. This is a true zero down loan program. The borrower can also include closing costs and or minor repairs in the loan if the house appraises for higher than the purchase price. However, there may be lender overlays with this. Some other benefits are that there's flexible credit consideration, including the fact that there is no minimum credit score requirement and alternative credit is allowed, but this is when you want to check for lender overlays on for sure. It's a 30-year fixed rate that is negotiated between the applicant and the lender. We do not dictate what rates can be charged. The program is not restricted to first-time home buyers, despite myths that it might be. In fact, we allow borrowers to own more than one residence in certain circumstances, which we cover later in the presentation. Funds can be used to purchase an existing dwelling or for new construction, which includes our single close construction program that we cover later in the presentation as well. We have no maximum purchase price, so if the borrower qualifies for the program, then whatever they can afford is eligible. Gift and grant funds for closing costs or down payment assistance are allowed. There are no acreage limits as long as the site size is common for the area, and then it's program eligible. And that's just a few of the benefits. There's just a lot of great things about the program. The benefits to the lender are that the loans are eligible for the secondary market. They qualify toward the Community Reinvestment Act performance. Our loans, they have a low delinquency and foreclosure rate. They are 90% guaranteed by Rural Development, which reduces the risk to you, the lender. We have a lot of training resources available, either self-paced or personalized, and we offer a streamlined application process. So let's cover program eligibility. Because this is a federally run program, there are some eligibility requirements that just must be adhered to. The program must be in an eligible rural area. The total household income must be within 115% of the median household income for that area. The applicant must be a U.S. citizen, non-U.S. citizen with a valid Social Security number and or qualified alien. And on March 7th, 2023, we announced in a Gov delivery notice a 2-year extension of guidance regarding non-U.S. citizens with valid Social Security numbers and employment authorizations. They must be documented with forms such as the I-766, which we touch a little bit on that in the training as well. The loan amount must be supported by the appraised value. The borrower must have the ability and willingness to repay the loan, and the borrower cannot qualify for traditional credit. So let's kind of break it down a little bit. Let's go over the applicant eligibility. The borrower must not be able to obtain conventional mortgage credit, and these are some of the things that we look for. Does the borrower have personal non-retirement liquid asset funds of at least 20% of the purchase price? Can the borrower pay all closing costs plus a 20% down payment? Does the borrower meet the qualifying ratios of no more than 28% PITI and 36% total debt ratio? Does the borrower qualify based on credit history for a conventional loan? And can the borrower qualify for a conventional loan with a 30-year term, without PMI? So if the answer is no to any of these questions, then the lender and the applicant, they certify this, that the borrower doesn't qualify for conventional credit by signing the 355521. And I just want to note that FHA and VA are not considered conventional credit. So SAM stands for System for Awards Management. It is required that anyone who participates in our programs is run through this database to verify they've not been suspended or debarred from participating in federal programs. If they have, they are not eligible for a loan with rural development. So you'll run the borrower through the SAM website at www.sam.gov. You can also find more information about who is party to the transaction in our regulations or handbook as noted on this slide. You want to ensure that SAM has been checked prior to the request for conditional commitment and within 30 days of the loan closing. So here's a snapshot of what the SAM website looks like when you run the borrower's information. Again, the website's www.sam.gov. Once you receive a response, you'll fill in the information requested on the additional data screen in GUS. It's actually only required on page 1 of the 355521 if the file is not run through GUS. If there are no SAM findings, you'll mark the box No to indicate the borrower has not been debarred from business with the federal government. If you mark this box Yes in GUS, you'll receive an ineligible response. To be eligible, the applicant must be a U.S. citizen, a U.S. non-citizen, national, or a qualified alien. We are making a change that we anticipate going into effect April 1, 2024 with regards to the SAVE system. This system was used to run the borrower's information and determine the applicant's legal residency and eligibility for the Single-Family Housing Guaranteed Loan Program. That system will be removed from the GUS screens, and it will become the approved lender's responsibility to document the applicant's legal residency. Applicants are required to have a valid Social Security number and evidence of continued residency and income. The approved lender should collect all necessary documentation needed to validate their eligibility, and it must be retained in their permanent case file. I also want to remind everyone that beginning May 20, 2022, USDA temporarily revised Chapter 8, Paragraph F regarding acceptable citizenship or immigration status in our handbook. This waiver allows for those individuals with a valid Social Security number and valid employment authorization documentation to be eligible to participate in the Single-Family Housing Guaranteed Loan Program. And that there's been an extension to the waiver, and it now expires May 2nd, 2025. We do, I'm not sure why this slide is blank. We do allow borrowers to retain ownership interest in one additional single-family housing property if the property is not financed with USDA. We only allow a borrower to have one loan at a time with rural development. The applicant must financially qualify to own more than one home. The home being purchased will be their primary residence, and the current home no longer meets their needs. So some examples of this would be relocation due to new job, maybe they require a larger home for growing family, but you just need to make sure you document all this information in the permanent loan file. Oh, I see why it's blank now. All those bullet points are going to come up. Sorry about that. Fancy. Here we go. The home purchase must be the borrower's primary residence. They must occupy the home within 60 days of the loan closing. It must be adequate and modest as well. So I always like to ask, what is modest? Although there is no limit to the purchase price or the amount financed, our income limits and ratio requirements are actually what dictate modest. This program is designed to assist people with moderate or low income purchase affordable housing based on their repayment ability. So let's go to income eligibility. Our income limits are mandated by the Housing Act of 1949. Therefore, because they are a statutory requirement, they must be strictly adhered to, and no exceptions or waivers can be made. At the time of the loan approval, the adjusted annual household income cannot exceed the moderate income limits. It is the lender's responsibility to review and document the household income to determine eligibility. So be sure to show us how you got your figures. The income limits can be found on the Single-Family Housing Guaranteed Loan Program website as well. The program's eligibility site provides an easy resource to determine your client's income qualification. This is a great site to keep bookmarked. You can either click on the income eligibility button, which will have you enter information to help you calculate the annual and adjusted annual figures, and then it'll make a determination, or you can select the income limits. The income limits button will open a PDF that lists limits by state and county. My preference is actually to look at the PDF file because there's data entry into the other piece of it. So it's a quick glance at the PDF file. Rural development looks at income 3 different ways. However, we have two calculations for the actual income. One calculation is to determine program eligibility with the annual and the adjusted annual household income, and the other is to determine the borrower's purchase qualification with the repayment income. The annual household income, this would include the income of every adult household member who will be occupying the property for all or part of the next 12 months. The adjusted annual household income, you apply allowable deductions that your loan applicant qualifies for to arrive at the adjusted annual household income. And this is actually the amount that is used to determine program eligibility. And then last is the repayment income, which determines the borrower's purchase qualifications. The repayment income calculation is similar to other programs and determines repayment ability and affordability for the applicant. So all are equally as important. For annual income, you'll want to include income from all adult household members. This includes any benefits that are received on behalf of minors. For any adult full-time students who are not party to the note or spouse of the applicant, you'll count the first $480 of earned income. For assets, you're going to include income from cumulative household non-retirement assets of $50,000 or greater. You'll also need to include all sources of income. If the borrower earns or has earned overtime, bonus, commissions, it must be included unless you can document with certainty that it will not continue. The attachment 9A is a helpful tool in determining what to include and what not to include, as well as the documentation required. It can be found under the Loan Origination tab on the Link Training and Resource Library page or in Chapter 9 of Handbook 13555. Some items that can be excluded are things like lump sum or sporadic payments, but you need to be sure to document that these are not received on a regular basis or haven't been received on a regular basis. Section 8 housing vouchers, student loans, SNAP benefits, and unreimbursed employee expenses. Rural development does allow deductions to the annual household income that will calculate the adjusted annual household income. Some examples would be the $480 deductions per eligible dependent, child care expenses, medical expenses, elderly household member, et cetera. So you'll refer to the attachment 9A, pages 23 and 24 for further guidance on this. The deductions are super important when it comes to qualifying the applicants. The deductions could reduce their household income enough to qualify under the USDA income limits. So rural development allows deductions to the annual household income. That'll bring you to the adjusted annual household income, which is what the eligibility is determined by. So here's an example in this slide. Let's say the income limit is $110,650, where they want to purchase the home. However, their current gross annual income is $117,000. So it's easy to quickly say they don't qualify because at a quick glance they're over the income limits. But this is where I like to say dig deeper. This family actually has 3 dependents, which is a $480 deduction for each child. So if we subtract that out, they're at a gross annual income of $115,560, which is still over the income limit. So let's keep digging. Guess what? They also have child care expenses of $500 a month for 12 months. That can be documented. That can be documented to meet the guidelines for rural development. So after we deduct that $6,000 for the child care expenses and the $480 per child, their adjusted annual income is now $109,560, which is below the income limit, and now they qualify. So at first glance, this is a borrower that may look like they're over the income limits, but if you dig a little deeper, maybe they qualify for some deductions to their annual household income. So don't just assume they don't qualify. Repayment income only comes from parties to the loan and must be considered stable and dependable in order to repay the mortgage debt. And unfortunately, cosigners are not permitted to bulk up the repayment income. Some basic guidance for repayment income eligibility is a 1-year history for base wages, bonus commission, overtime, part-time, secondary employment, expense allowances, and so on. A 2-year history is required for most self-employment scenarios, seasonal and unemployment. Court-ordered child support and alimony would only require a 6-month history. Voluntary child support and alimony require a 1-year history of receipt. But you do want to make sure that you check for lender overlays on documenting and calculating your repayment income. The attachment 9B is an income calculation worksheet that can help you to document all household members' pertinent information and how you calculated the income. And although this is no longer part of the 355521 anymore, you are still required to submit either the attachment 9B or a lender's income calculation worksheet with any full doc, refer, or manual submission. And although you're not required to submit your income calculation worksheet on Gus Accept files, you do need to keep a copy of it in your lender file. You need to show evidence to support a historical receipt of earnings. You need to analyze any gaps and determine if the income is stable and dependable. And you should always watch for applicant income with sharp increases or decreases in earnings and document that. The tax-exempt income, such as Social Security, may be grossed up by 25% to calculate repayment income only. You do not gross up tax-exempt income for the annual household income calculation. So what do you need? Minimally, you're going to need 1 recent pay stub with year-to-date figures, a written VOE, and a verbal VOE within 10 business days of closing. But if you're unable to obtain a written VOE, you can collect pay stubs covering 4 weeks of earnings, 2 years of W-2s, and a verbal VOE within 10 business days of closing. Self-employed borrowers will need to submit 2-year signed individual and business tax returns with all schedules plus a recent P&L, or IRS transcripts with all schedules plus a recent P&L. And just to note, the P&L is not required to be audited. You will need to complete a trend analysis for the applicant's business and confirm the business is operational within 30 days of the loan closing. So let's talk credit. The lender is responsible for prudent underwriting practices and ensuring that an applicant's credit history demonstrates an ability and willingness to meet their debt obligations. GUST is merely a tool to evaluate risk, but does not replace the judgment of an experienced underwriter. One of the biggest points to acknowledge is that the program has no minimum credit score requirement, but again, that is one where you could see some lender overlays. It's important to note that although our handbook and CFR are the regulations and guidance for the program, lenders and investors may have overlays across the board, so you always want to check lender guidance as well as ours. In some cases of adverse credit, the lender's underwriter can grant credit exceptions as well. A credit score is a statistical number that evaluates an applicant's creditworthiness based on their credit history. The credit score considers payment history, amount owed, percentage of credit used, length of credit history, types of credit, and newly acquired credit. Your GUST results will only be as accurate as your input. Therefore, please make sure your input is precise and accurate. I like to say garbage in, garbage out, so make sure that you're precise with what you put in. If you receive a GUST accept, that's it. You'll not need to validate the credit score. This includes the GUST accept full documentation required. A refer with caution, or manually underwritten file require that one applicant have at least 2 historical trade lines. They must be open, closed, or paid in full and have a 12-month history. If they do not have the 2 eligible trade lines on their credit report, non-traditional credit can be used, but it must be verified. Examples of eligible trade lines are revolving accounts, installment loans, credit cards, collections, and charge-off accounts. Examples of ineligible trade lines are child support, alimony, and court-ordered debt. So for applicants that do not have a traditional credit history with a validated credit score, or if they have no credit score, the lender can document their willingness to pay debt obligations through alternative sources. The use of a non-traditional credit history is not a reason to deny a loan. Regardless of the GUST recommendation, it is the lender's responsibility to review and determine that the loan meets agency guidelines and is an acceptable credit risk. So for applicants with a 12-month verification of rent, or VOR, only 2 trade lines are required, and the VOR can be one of them. The second trade line must be an eligible traditional trade line from the credit report or an eligible non-traditional trade line. Both require a 12-month history. For applicants with no rental history, 3 trade lines are required. The trade lines may be a combination of traditional trade lines from the credit report with a 12-month history or non-traditional trade lines, which can be documented with either a non-traditional mortgage credit report, self-reported trade lines on a traditional credit report, or evidence from third-party verifications such as canceled checks, money orders, receipts, electronic payments, payment histories from the creditor, company, or bank statements that clearly identify debit payments for the service or the product. An eligible non-traditional trade line must have a 12-month history and cannot have been closed more than 6 months prior to the loan application. And some examples of acceptable non-traditional credit sources are rent or housing payments, utility services such as gas, electric, water, landline, telephone service, etc. The program also provides for flexibility in credit analysis. We know there are often unique and non-recurring circumstances, and we recognize the ability of our lending partners, experienced underwriting staff, to make these determinations. When making exceptions, we expect that the underwriter document that the issues were temporary in nature, beyond the applicant's control, and unlikely to reoccur. The underwriter will document the exception and justification on the 1008 form and submit it with the file. You do want to make sure that your letter of explanation touches on these things, though, and that you keep in your file. The credit exceptions are never required for GUST accept files, but for all other GUST recommendations, they are required. They would be required for files for foreclosures, bankruptcies, deed in lieu, and short sales within the past 36 months. Credit exceptions cannot be made for delinquent court-ordered child support, delinquent federal non-tax debt, and a previous loss to USDA. A credit exception is not required for collection accounts regardless of the GUS recommendation. However, if the combined total of all non-medical collections exceeds $2,000, the lender must require payment in full of these accounts prior to closing, or use an existing repayment agreement amount, or include 5% of the outstanding balance as a monthly payment. All open collections must be listed on the asset and liabilities page in GUS. A verification of rental history is not required for GUS Accept or Accept with full doc files, but it is required for a refer with caution, or manually underwritten loan if either borrower has a credit score below 680. And then just to note, one rent payment that is 30 days late in a 12-month period will be considered a significant derogatory credit, and it will require a credit exception from the lender. We have created the attachment 10A, the credit matrix. It's a great resource that provides guidance on what credit documentation is required. All right, let's go into ratio analysis. I think we all know what's included in the PITI and the total debt ratios, but let's go over it really quickly. The PITI is principal and interest, hazard insurance, real estate taxes, the monthly escrow for annual fee, homeowners association dues, flood insurance, and any special assessments. The total debt ratio includes the PITI, any long-term obligations that have more than 10 months of payments remaining, revolving and installment debts, rental loss, balloon, and deferred payments. But I want to talk about really quickly installment liabilities with less than 10 months remaining. The debt may be omitted if the monthly payment does not exceed 5% of the monthly repayment income. So if there's less than 10 months remaining on an installment debt, you want to double check to make sure the payment does not exceed 5% of the monthly repayment income before omitting it. If the property is in a community property state, you'll need to manually enter the obligations for the non-purchasing spouse as additional expenses on the assets and liabilities page. For outstanding student loans, regardless of the payment status, lenders must use the payment amount reported on the credit report or the actual documented payment when the payment amount is above zero. Or when the payment amount is zero, you will use a half or 0.50% of the outstanding loan balance documented on the credit report or a creditor verification. If student loans are in the applicant's name alone but paid by another party, the debt still remains the legal responsibility of the applicant, so they have to be included in the ratio. And then student loans that are in a forgiveness plan, like police or teachers, I think is two big ones that I've seen. So if they're in a forgiveness plan or program, they still remain the legal responsibility of the applicant until they are released of liability from the creditor. So you'll still have to count the payment. Child support, alimony, and garnishments must be included unless the applicant has a documented release of liability, or if there are 10 payments or less remaining and the payment does not exceed 5% of the monthly repayment income. And if these are not listed on the credit report, you're going to need to manually enter them as additional expenses on the assets and liabilities page. All co-signed obligations must be included in the total debt ratio unless the borrower can document the other party has made the payments over the last 12 months on time. This can be documented with canceled checks, money order receipts, and/or bank statements made by the other party. A previous mortgage will be included in the total debt ratio if it was transferred to another owner without a release of liability. The only exception to this is if the new owner can document a 12-month payment history prior to this application for a loan, or in the case of a divorce and the borrower provides divorce decree ordering the spouse to make the payments. Business debts can be excluded from the total debt ratio as well if it's documented that the business has made the payments for the last 12 months. If an applicant's PITI ratio exceeds 29% or the total debt ratio exceeds 41%, and the GUS underwriting recommendation is a refer or refer with caution or a manually submitted file, then a ratio waiver is required and it must be requested and documented by the lender. We do grant debt ratio exceptions for refer with caution, and manually underwritten loans if the following apply. The PITI ratio cannot exceed 32%. The total debt ratio cannot exceed 44%, and the credit score of all applicants is above 680, and at least one of the listed compensating factors apply. So the borrower needs to either have 3 months PITI savings, cash reserves post-closing, cash on hand does not count, or the borrower has been continuously employed with their current employer for a minimum of 2 years. I also want to note that GUS files that receive an accept or accept full doc underwriting recommendation do not require debt ratio waivers. But if you get an approval with higher ratios, a GUS accept, you do want to make sure that your data entry is correct. So let's go to property requirements and special property types. The program does allow for most types of available housing in rural America. Existing properties must be single-family residents, but can be stick-built, modular, which is treated as a stick-built, a townhome, a condominium, or a new manufactured unit. Currently, we do have a pilot program in some states that allow existing manufactured housing built in 2006 or newer. I do go over that a little bit more on another slide. A single unit in the duplex is also allowable when the duplex units are separately deeded. Of course, the primary requirement is that to the program is location. So the property must be located in an eligible area. But checking the eligibility is easy with our online tools. You'll go to the eligibility page and select property eligibility. Here you're going to input the property address and select go. You can also select the state and zoom in, or just use the zoom in tool on the left. Once you zoom in, the shaded areas will show up as ineligible. When you locate the property, you're going to want to pin the location on the screen. If you put in the address and it locates it, it will clearly say if the address is in an eligible or ineligible area. But the system can struggle to locate new construction, therefore you'll likely need to zoom in and find the location manually. I also recommend including a screenshot with your submission to help the review staff locate the address themselves a little quicker when you submit the file if you put a pin in it. The other thing to check if you're getting an ineligible or it's not locating the property is you want to make sure that the input is correct and spelled right. You can double check your address at USPS.com for accuracy, but sometimes if you remove court, street, circle, those kind of things, sometimes then it'll pull up the address. So if it's struggling, then you can play with that a little bit if you need to. We don't limit site size, but the property must be predominantly residential in design, character, and use, as well as be typical for the area and evidenced by the appraisal and comps used. So be sure to review the comparables used in your appraisal report. Buildings that are primarily used for income-producing purposes are ineligible. However, some minimal income-producing activities may be allowed. So, for instance, a home-based operation such as childcare, product sales, or crafts, those are allowed. Buildings that are no longer used for commercial operation and are now used for personal storage are allowed. However, this is kind of a touchy one, so you're going to want to make sure that it's documented in the appraisal and in the file. So if there's any question, you've got documentation on it. It's the same with land. A hobby farm or garden is allowed, and the property must be predominantly residential in use, character, and appearance. But land that is used for income-producing purposes will not be eligible. We do require that the property meet the minimum standards of HUD Handbook 4000.1. This is certified by a qualified appraiser or home inspector as determined by the lender. We do not require termite or pest inspections unless the lender, appraiser, or state law requires it. We do not require thermal inspections for existing dwellings, and in-ground pools are accepted without any sort of waiver. You can finance the purchase of a condo as long as it's acceptable by HUD, FHA, VA, Fannie Mae, or Freddie Mac guidelines. You'll need to document the approval of the condo on the 1008 form or on the attachment 12B condo certification, and you just retain it in your lender's permanent file. You do not submit that in with your loan. So manufactured homes, we currently have a pilot program in some states for manufactured homes constructed on or after January 1, 2006 that allows them to be funded with a loan, with a rural development loan. If the property is not located in a pilot state, then we'll only lend on new manufactured home purchased directly from the manufactured home dealer. So what is considered new? New would be less than 12 months old and never occupied. We can finance the site development work, the manufactured home, transportation, and setup costs, as well as the purchase of the site if not already owned by the applicant. But this is another one that you're going to want to check for lender overlays on. And at the top of this slide, you can see the states that the pilot program is currently in. I believe this is under review, and hopefully it'll get rolled out to all states, but for now, this is where we're at. Along with the ability to fund regular new construction projects, we offer a single close construction program to aid in improving the supply of affordable housing in rural America. As the name suggests, it's a single close. It's a single close, meaning one set of documents to spare extra and unnecessary costs. The single close process was designed to protect all participants. So what's cool is that USDA's loan note guarantee is issued at the loan closing, even before shovel goes in the ground to move the dirt. The realtor gets paid at closing, and the builder is protected because the build is funded at closing as well. So if something happens with the borrower, the lender continues to work with the builder to complete the construction. Then the lender sells the home, and if there's a loss, the lender submits the loan note guarantee for reimbursement. And this actually reduces the risk to both the lender and the builder. Lenders can sell the loans on the secondary market immediately after closing. So the borrower's budget isn't too stretched. You can fund up to 12 months of payments that can be rolled into the loan, so the borrower won't have to pay rent plus their new housing expense during construction. They can also include the cost of acquiring the land or paying off any balance on the land that's already owed. There are two versions available, the interest-only version and then the securitized version as well for this program. So let's move on to our guaranteed underwriting system, GUS. Rural Development uses a system called GUS, which stands for Guaranteed Underwriting System. All qualifying files must be submitted through GUS. It's super important that all the information entered into GUS is accurate and matches the 355521 along with any other documentation submitted. GUS evaluates the credit risk of the borrower. It does not replace the judgment of an experienced underwriter. GUS incorporates a modified version of the FHA total scorecard, but does not evaluate the dependability of repayment income. And most importantly, though, we count on lenders to make sure all file submissions have been reviewed by an underwriter to ensure they qualify for our program. There are different roles available in GUS, and we leave it up to the lender's security administrator to set them up how they see fit. So as a lender, you want to make sure that only experienced staff have the ability to submit files to USDA for final approval. The security or branch administrator has many of the same roles, but they also set up the roles in GUS for all organizational users. We recommend that lenders have a minimum of two security administrators in case one of them is out. They are also the GUS contact for the organization in addition to administrating staff access to GUS. Representative with final submit authority, this is typically an underwriter, a team lead, or a manager. They can import or manually input applications, certify the loan has been underwritten by the lender, confirm data is accurate and consistent with the lender loan file, and perform preliminary and final submissions. Rural Development only does a review of the file submission. We do not underwrite it. Therefore, when the representative for final submit authority submits a file, they are saying that this file has been reviewed and underwritten and that it meets rural development qualifications. This is why it's so important that lenders make sure that only experienced staff are assigned this role. Then we've got the representative or lender agent broker. Typically, this would be a processor, loan officer, or third-party originator. And they can import or manually input applications, run preliminary submissions. But just to note that the lender agent broker, they must release the control of the application back to the approved lender for final submission, though. So it's a little different as a third-party originator. There are two ways to submit files directly through GUS or manually when required. Although the submission process looks lengthy, it's more streamlined than you would think. So first, the application is input or imported into GUS. Then documents are uploaded into GUS. The loan approval official does a final submission. When they do this, they're saying that the file meets rural development regulations. Then they submit it to rural development for review. GUS then notifies rural development that the loan is ready for review. The loan is reviewed by an agency official. Then rural development issues the conditional commitment, asks for additional documents, or denies the loan, which is very seldom. And just to note, you have 30 days from the loan closing to request the LNG. So the clock is ticking once the loan closes. Gus will give one of three recommendations: accept, accept with full doc, refer, refer with caution, or ineligible. Gus loans that receive and accept generally require the least number of documents. You're going to want to review your findings even for a Gus accept, because it may have been randomly selected for data integrity review and would now be a Gus accept with full documentation review. A refer or refer with caution require further review and will require a full documentation submission as well. Be sure to utilize the attachment 15A with all submissions. It's a checklist of all required documents for the loan, for each loan type. The lenders must review the Gus findings report and submit documentation accordingly. Agency staff will not review a loan file that is incomplete and condition for missing loan documents. Files that are severely incomplete will be released back to the lender and it does create delays. Regardless of the Gus underwriting recommendation, you'll upload all documents via the Gus application. There's no need to email anything to rural development. For help navigating through our guaranteed underwriting system, we offer a Gus Lender User Guide. The guide is available for download on our the Lender Training and Resource Library page under the Gus tab. It's also available, I believe, in Gus. This guide can help answer most questions that you have when you're going through the guaranteed underwriting system. So we do have lots of tools that are available for you. When you're submitting a file, you always want to check our turn times. You want to prepare yourself and your borrower with the expectation of when you might receive the conditional commitment. Just remember that loans are reviewed in the order they are received, and unfortunately, we cannot do any rush requests. If you're a third-party originator, you are going to want to take into consideration that you're going to be submitting it to a lender, and then they're going to submit it to us. So you're going to need to find out what their turn times are as well and add them to our turn times. I highly recommend signing up for our Gov Delivery notices if you haven't already. These notices, they keep you up to date on information regarding the rural development program updates and changes to the handbook and regulations, as well as upcoming training events, our newsletter, things like that. So if you haven't signed up for it, I would recommend that you sign up for that already. And the website for that is at the top of this page. You can also sign up on the Link Training and Resource Library page and our Guaranteed Lender page as well. And then just to note, the first place that you always want to look for program guidance is the 7 CFR Part 3555. This is the regulation to administer the Single-Family Housing Guaranteed Rural Housing Program. The Technical Handbook 13555 provides further guidance to the regulation. And usually, if you look at those two things, you can get answers to your questions. But if not, you can always reach out to us. We're here to support you. You can locate the handbook either on the Link Training and Resource Library page or on the USDA Rural Development website. Our Link Training and Resource Library page is always available, and it has a number of different trainings to help you administer the program. I just always recommend that if you have a topic that you think you need a refresher on or you feel a little weak in, that you search for training in that area. But we're also available to assist in any way that we can. The contact information on this slide is available on the Link Training and Resource Library tab, or on the Link Training and Resource Library page on the Contact Us tab. So if you need to get in touch with anybody, that's available at your fingertips. And pretty much that's everything that I have for today. I just want to say thanks again for joining us, and make sure that you keep an eye out for additional announcements for further trainings and anything else that's upcoming. So have a great day. Thank you.